Hello, Eric Walczykowski here, CEO of Bespoke Partners and host of Tailored Talent. Today, I'm joined by Peterson Loftin, our growth equity go-to-market specialist. Peterson, welcome to the show.
Thanks for having me, Eric.
Peterson, lots going on right now in the market. Talk to me a little bit about what you're seeing in terms of growth equity trends and what all things go to market.
Yeah, so I think kind of two big trends to maybe focus on. So one would be AI's domination really of growth equity right now. This explains why tech share of private equity surged from 34 to 40% between Q1 and Q3 of last year, according to EY. And what we're seeing is that the real value creation opportunity here isn't necessarily in developing the AI, but in transforming operations and business models through its implementation. And then the other big trend we're seeing is, candidates with a strong record in growth stage companies are just built different and have a genuine passion for scaling. These leaders are energized by building something substantial and really leaving their mark. What distinguishes them is the ability to thrive in an entrepreneurial environment with fluid roles and drive an immediate impact to the business.
No, absolutely. So with the move of AI and AI being relatively new, how's this impacting the scorecard? I mean, I would imagine that things we're solving for when we do go-to-market searches is agility, adaptability, a growth mindset. Would you agree with that? What are you looking for in leaders that can drive implementation of AI in the sales cycle?
Yeah, absolutely. So we are looking for agility in their prior experience at the companies they've been at before. AI is a newer industry, if you will. So you're not necessarily going to get prior experience with an AI-driven business, but we are looking for a track record and a history of that agility and ability to implement AI into the business, even if the company itself isn't an AI product.
Peterson, thanks for sharing your thoughts on the trends in the growth equity market. How's that impacting compensation?
Yeah, absolutely. So growth equity stage businesses, their compensation packages are inherently very different from those in the mid-market and above. Compensation for growth stage executives has steadily increased over the last year, reflecting competitive talent markets and leadership value in scaling these businesses. The packages balance immediate cash constraints against future equity value, tend to have lower base salaries, but substantially higher equity multiples upon an exit.
No, fantastic. I mean, great points on compensation. One of the things that we're seeing in the broader market is this talent perfect storm. And it's this notion of longer hold periods, not a lot of M&A. So you're not getting this natural churn and it's just compressing tight talent. What are you seeing in growth equity as it relates to talent and go-to-market?
Yeah, no, that's exactly what we're seeing in go-to-market growth equity as well. Longer hold periods, investors are not exiting on the timeline that they thought they would a couple of years ago. And it's creating a tremendous amount of demand really for that upper quartile and upper decile of candidates, which is what we're focused on here at Bespoke and what our clients engage us to go out and find for their businesses.
No, absolutely. Historically, go-to-market executives have turned over every 18 months. I saw a spike in go-to-market turnover in the last quarter. It sounds like that's still happening and boards are evaluating or top grading their sales talent.
Yes, no, that's absolutely what we're seeing in go-to-market as well, Eric. Go-to-market executives tend to have fairly short shelf lives. I think the average turnover is under 2 years. We're continuing to see that happening here, particularly for investors where, again, their timeline to exit has been stretched and trying to figure out if the team they have today is still the right team to carry them over the next 2 to 3 years to an exit.
No, absolutely makes a lot of sense. Growth equity firm makes an investment. Talk to me a little bit about value creation and post-investment support you're seeing from the private.
Yeah, great question, Eric. We see a variety of ways that investors can support their businesses post-investment. So, establishing a dedicated value creation team that focuses on operational improvements and also revenue growth. We do see cross-portfolio idea sharing and resource sharing, part of why Bespoke founded our leader community recently. We see investors bring in talent partners like Bespoke to build out the executive team, either replacing execs and or growing the team. And then we also see private equity firms engage operating partners, experienced executives with deep industry knowledge that can work directly with the ELTs at these businesses, provide guidance, support the management teams, and drive value creation.
No, these operating advisors many times are extremely helpful and valuable, and we certainly have them through our partnership with the AEA, and just been great sounding boards as we build the company. Talk to me a little bit about the strength of the management team and how you see that strength of the management team driving outsized results.
Yeah, absolutely. So again, growth equity really requires leaders who can balance rapid scaling with operational discipline and capital efficiency, navigating that tension between aggressive growth and profitability mandates, which are nearly universal today, I would say. So I think you look at a couple of things. So an experienced management team signals stability and growth potential, making the company much more attractive to future investors. That perception can also lead to higher valuation multiples. And then in addition to that, I think risk mitigation is another way of looking at it. So buying a business where the investors anticipate having to clean house, that introduces a lot of risk for them in buying a new business. So having a stable team, again, just inspires a lot of confidence that they're buying a team that's going to be around for the next turn and that they're not going to have to fully replace upon buying the business.
No, makes a lot of sense. Talk to me a little bit about growth equity versus middle market and that team, and really the ability to attract A-level executives to growth equity and retain them versus mid-market.
Yeah. So we're actually seeing growth firms having a tougher time retaining talent as compared to their mid-market counterparts. Our internal data shows that turnover rates are significantly higher with growth stage businesses. Additionally, growth stage firms often face a greater challenge in retaining talent due to compensation structures that are generally less competitive and less cash rich than later stage businesses. The equity upside can be compelling, but cash compensation and stability tend to be stronger at more mature firms, making those later stage opportunities a bit more attractive to candidates, that particularly those that are more seasoned and have operated at that level.
No, absolutely. And look, I've done a couple searches in growth equity recently, and the key thing I find there to really attract the talent is quality of the investment firm, interaction with the board, and really the articulation of that value creation plan. Because in growth equity, because so much is riding on the value of the equity and where we go, a believable value creation plan that you can get to in a reasonable period of time, I think is quintessential in really attracting top tier talent. Wouldn't you agree?
Would absolutely agree. And also in retaining them. And, we talk to executives daily that joined a business in 2021 or 2022, and the valuation of the company looked a lot different then than it does now. And to our earlier conversation, hold periods are extended, and we're seeing a lot of executives have to come to the conclusion of, do I really want to stay where I am for the next 3 years? Or should I join a business where maybe there was a transaction in the last year or two, the valuation is much more reasonable, and I have a better chance of realizing a wealth creation event upon exit than in my current company?
No, absolutely. Talk to me a little bit about succession planning in growth equity, particularly as a lot of these businesses are founder-led and founder-driven. Talk to me what you're seeing there.
Yeah, so oftentimes that founder transition and sort of the ensuing shakeup will happen 6 to 12, maybe 6 to 18 months following an investment. And getting the timing right around elevating leadership roles from a VP level to the C level, this impacts retention and talent acquisition as well. The market has really had a fundamental shift from growth at all costs to demanding capital efficiency. And our team's understanding of these nuanced processes ensures that we can maintain momentum for the business while also respecting the founder's legacy and ensuring that there's a small amount of disruption as possible. We really look to identify leaders who can deliver impact both to the top and bottom lines, creating that sustained growth that's going to drive a successful exit down the road.
No doubt. And I think, look, one of the common succession plans over time, particularly in growth equity, has been up through the go-to-market route. It's right. The CRO to the president to now the CEO and that founder transition. And I think we're still seeing that today because growth equity, by its nature, you got to grow. And so that tends to be the most important value creation lever. But I think the key that at least I'm seeing across the market is that those growth executives that came up go-to-market, they do have a very strong background in the science of sales, the science of marketing, that drives that operational discipline. Because in today's market, if we don't have that capital efficient growth, which is backed by operational discipline, it's just not going to work. Would you agree with that statement?
Yes, Eric, that's exactly what we're seeing in the market. There's just been a relentless focus on profitability and investors that are only willing to invest capital when there's a positive ROI on that investment. We're far removed from the growth at all costs environment of 3-4 years ago.
Well, it's definitely been an interesting year so far. I still think there's a lot of uncertainty in the market, but the key is, as I always like to say, is focus on building a great company and good things will happen. And that is true as well as in attracting and retaining the best talent. If you're building that great company, people want to be there. One last question for you, Peterson. How's the golf game?
Golf game is up and down. We have a big trip this summer to Bandon Dunes in Oregon, which I'm very excited about. So trying to get the game in a better place while also not having the handicap drop too low before that trip.
Very cool. Well, I look forward to hearing about that. Peterson, thanks for joining me today. Look forward to having you back soon.
Thanks, Eric. Appreciate it.